In this video, we're going to talk about the company that quietly became the most powerful investor on the planet, and how it did it using your money, $14 trillion. That number's so big it doesn't mean anything. So let me give you something that does. If you are a public school teacher, there's a roughly 50% chance that your retirement fund is managed by one company. If you're a nurse, a firefighter, a cop, a postal worker, your pension is almost certainly inside this company's system right now. You didn't choose them. You've probably never spoken to them. But they have been quietly investing your retirement for years. And while they did, they became the single largest investor on Earth. The company is called BlackRock, and most people have never heard of it. Today, we are going to walk through the exact blueprint they used to get there. The technology, the crisis, the acquisitions, and the government relationships. Because once you understand the machine, you can't unsee it. BlackRock was born in 1988, out of a single room in New York City with one computer. A guy named Larry Fink, who was already famous on Wall Street for helping invent something called mortgage-backed securities, had just left his old firm after a catastrophic trading loss. He needed a new start. He and 7 co-founders launched the company under the Blackstone Investment Group. They weren't focused on buying stocks. They were focused on something nobody else was talking about at the time, risk. Specifically, what could go wrong, and how do you see it coming before it does? From that single Sun Microsystems workstation crammed between a refrigerator and a coffee machine, the team built a software system they would eventually call Aladdin. It stands for Asset, Liability, Debt, and Derivative Investment Network. But the name that matters is what it does. Aladdin doesn't pick stocks. It sees risk. It runs over 5,000 portfolio stress tests every week, monitors more than 2,000 risk factors every single day, and processes 180 million calculations every 7 days. It can simulate what happens to a portfolio if a pandemic hits, if a government collapses, if interest rates spike overnight. In 2020, Aladdin was processing over $21 trillion in assets. That number isn't BlackRock's money. That's the money of banks, insurance companies, pension funds, and governments around the world who all pay BlackRock to run their portfolios through this machine. Think about what that means. BlackRock doesn't just manage the world's largest pile of money. It operates the system that tells most of the world's biggest investors whether their money is safe. CalPERS, the California Public Employees Retirement System with over $260 billion in assets, runs on Aladdin. Deutsche Bank runs on Aladdin. The Bank of Israel runs on Aladdin. And those are just the names we know. BlackRock went public in 1999. And once it had that capital, it started buying. In 2006, it acquired the Distressed Assets Division of Merrill Lynch. In 2009, it made the move that changed everything. It bought Barclays Global Investors, the firm that owned the intellectual property rights to a product called iShares. iShares is an ETF, an exchange-traded fund. And if you don't know what that is, here's the short version. Instead of buying one stock, you buy a basket of stocks that tracks a whole market. The S&P 500, for example. It's cheaper, it's diversified, and for average investors, it was a revolution. BlackRock didn't invent the ETF, but after buying iShares, they became the world's largest provider of them. And that acquisition alone set the stage for the empire they would build over the next decade. 2008. The financial system is collapsing. Bear Stearns goes under. AIG is hemorrhaging. Fannie Mae and Freddie Mac, the 2 institutions that backstop the American mortgage market, are in freefall. The federal government is staring into a hole so deep and so complex they don't even know what's in it. Mortgage-backed securities, derivative contracts, collateralized debt obligations, instruments so tangled that almost nobody in Washington fully understood them. Almost nobody. Larry Fink had spent his career building these instruments, and he had Aladdin. The Federal Reserve Bank of New York called BlackRock, and not just once. They were tapped to manage the toxic assets of Bear Stearns, then AIG, then Fannie Mae, then Freddie Mac. At one point, BlackRock was managing over $130 billion in distressed government assets, while simultaneously managing its own clients' money. Let that sit for a second. The same company that is managing your pension fund's money was also managing the Federal Reserve's emergency bailout portfolio. The same Aladdin system giving risk advice to the government was also running the risk models for the institutions being bailed out. A former Federal Reserve official put it plainly, BlackRock was not just advising, it had become infrastructure. When the pandemic hit in March of 2020, the Federal Reserve launched one of the largest emergency asset purchase programs in history, buying corporate bonds to keep the economy from seizing up completely. They called BlackRock again. The firm was tapped to manage the corporate bond buying program on behalf of the Fed. In some cases, BlackRock was buying bonds issued by companies it already held stakes in through its own funds. The conflicts of interest were flagged by watchdogs. No meaningful action was taken. After 2 major government crises, 2 calls to the same company, BlackRock was not just the largest investor anymore. It was something closer to a private arm of monetary policy. While all of this was happening, the ETF market was exploding. Passive investing, the idea that instead of trying to beat the market, you just buy the whole market, became the dominant investment philosophy of the 2000s and 10s. BlackRock, Vanguard, and State Street captured almost all of it. More than 80% of all new investment money over the past decade has gone to one of those three firms. BlackRock alone controls roughly 35% of the entire domestic ETF market, because multiple ETF providers all track the same index, the S&P 500, for example. They are all holding essentially the same stocks, which means three companies now own meaningful stakes in virtually every major publicly traded corporation in America. The way it works, BlackRock charges investors around 30 cents per year on every $1,000 in its S&P 500 fund. 30 cents, that sounds like nothing, but when you are managing trillions, 30 cents times a trillion is $3 billion. The math of scale is staggering. For most of BlackRock's history, their power was indirect. They owned 5, 6, 7% of every major company. They had voting rights. They could push boards. But they didn't own the water flowing to your house. They didn't own the power line running to your building. That is changing. In January of 2024, BlackRock acquired Global Infrastructure Partners, a fund that owns airports, pipelines, water systems, and energy infrastructure across the globe. If you've flown through London's Gatwick Airport, you've been a customer of a firm BlackRock now owns. They are now attempting to acquire Minnesota Power, a utility that provides electricity to 150,000 people. Community members, elected officials, and a state judge have all raised alarms. The concern isn't just the price of electricity, it's the question of who gets to decide and who the decision serves. The pattern in cases like this has a name. Private equity buys the utility, rates go up, the firm sells it to another firm, rates go up again. The customers, who have no alternative, pay every time. In northern Michigan, one power company changed private equity hands multiple times since 2014. It has seen 4 separate rate increases. BlackRock calls these real assets. Larry Fink has said publicly that infrastructure, including the last mile power lines connecting energy to homes, is one of the most important unlock opportunities for the next decade, especially as AI data centers explode in energy demand and someone needs to own the power delivering it to them. And here is where it all comes full circle. Here's the part that should make you stop and sit with it. BlackRock manages money for more than 35 million Americans who are saving for retirement. More than half of all the assets it manages are retirement assets. Roughly half of all public school teachers in the United States are in pension plans managed by BlackRock. That money, your teacher's pension, your uncle's retirement, your own future security, is being used as the capital base from which BlackRock operates. It is what gives them the scale to buy infrastructure, to run Aladdin, to be the company the Fed calls. BlackRock would say they are acting as a fiduciary, that their job is to generate returns for those retirees. And to be fair, they have. But the system they have built in the process of doing that is one where the same capital that is supposed to secure working people, his futures, is also being deployed to purchase the utilities those same people depend on, and to extract fees from the roads they drive on, and to sit on the boards of the companies that employ them. That is not a conspiracy. That is just what it looks like when one company gets big enough. So let's come back to the question. How did BlackRock quietly become the world's largest investor? They built software in the late 80s that could see risk better than anyone else. They used that software to make themselves indispensable in the 2 biggest financial crises in modern history. They bought the companies that owned the ETF market, and they turned the pension savings of ordinary working people into the capital base for one of the most influential institutions on the planet. That is the blueprint, not fraud, not a conspiracy. A systematic accumulation of information, trust, and scale. So quiet and so methodical that by the time most people heard the name BlackRock, the company was already everywhere. Now, here's what I want to know from you, because this is part of a bigger conversation about who actually runs the systems that run our lives. What do you want us to go deeper on? Is it the Federal Reserve relationship, the ETF monopoly, the infrastructure acquisitions? Drop it in the comments, because I read every single one and your answer might be the next video. If this video made you think differently about who controls your money, share it with someone who needs to see it. We are currency theory, and we follow the money.